Let's get more on both Oracle results and Google's big run. We're joined by Luria, the managing director at DA Davidson. We know that you're on the last hour in overtime, Gil, and you've had some time now to digest the numbers. Are we going to look back on this day and say this is the day that Oracle got re-rated?
Yes, the number is staggering. That 144 billion number 5 years out is absolutely staggering. That means that they will grow that business 10x in the next 5 years. So plenty of reason to get excited. Let me talk about a couple of things that we do need to consider here. So one of them is that what's happened, and this has happened dramatically over the last couple of years, is that the big hyperscalers, Microsoft Azure, Amazon Web Services, Google Cloud, have gone to a strategy of offloading their capacity to other data center providers. That's the big Nebius deal. Those were the CoreWeave deals. And now all three of them are taking their capacity and putting it on Oracle. These are not organic customers to Oracle. This is Microsoft, Google, and Amazon's customers that will use Oracle capacity. So we have a shift of where the capacity is coming from. So let's keep that in mind. And those are the big deals that Oracle is now putting in its backlog. That's one. Two is, it's very unlikely that they're going to get to $144 billion of revenue in 5 years. The bottlenecks to get there are very significant. Electricity, we're going to run out as early as next year. We're not going to be able to 10x electricity capacity in the next 5 years. Chips, there's only so much that can come through TSMC, whether it's NVIDIA chips or Broadcom chips. TSMC can only grow so fast. And then finally, capital. All these companies are now relying on the ability to borrow tens of billions, and now we're talking about hundreds of billions of dollars that were previously not coming through the debt markets. So there's going to be competition for that debt capital, not just between Oracle and CoreWeave and Nebius and Crusoe and Lambda, but Meta is now going to the debt markets to borrow. Elon is going to the debt markets to borrow to fund data center capacity. So we're going to have multiple bottlenecks that mean we will continue to grow compute, but we're not going to 10x it in the next 5 years.
So there are a lot of asterisks, basically, surrounding Oracle's guide. How much do you then put into your model, and where does that get you in terms of PE or price target?
Yeah, so what's important is that next year's number will be a lot higher. So we are all going to increase our numbers. Now, keep in mind, this revenue is coming in at a very low, if not negligible margin, where the revenue most of Oracle's revenue is declining and it going away at 50% margin. So the mix shift is very dramatically lower. That's why they missed. That's why earnings growth is not going to be anywhere near the revenue growth. But it doesn't matter. As long as the margins are positive, we're all going to be increasing our numbers based on this, and the valuation should be going up. The reaction to the stock is very understandable.
Gil, it's Karen. Thanks so much for being on. Can you just drill down a little more on that margin from this kind of business versus the higher margin business you talked about? What is it, 1%, 2%, 2 or 3? What are you thinking?
Yeah, so even Amazon Web Services, which is the biggest hyperscalers, talked about the GPU business being a very low margin business. Oracle Cloud is at an order of magnitude smaller and a price, the lowest price provider. So they are willing to accept very low margins. So yes, I would say it's very likely to come in at single digit margins, especially for the next few years. Again, as the mix is going from 50% margin, it's going to go to low single digit margins. But again, positive margins on in revenue that is incremental, and that's what they're focused on.